taxes. The dreaded word no one wants to address. How much will taxes actually affect us when we get into retirement? This is something we definitely want to have in the talk through and consider this program today. When we look at taxes, there's a difference between tax planning and tax reporting. And alongside me in the show, Joseph Clark, our managing partner, we're going to get in deep into really what taxes cost you when distribution arrives and you're now living off the resources you've saved for 30 years. Welcome to Consider This Program. I'm the co-host, Grant Soliven, manager and advisor operations of the Financial Enhancement Group. And beside me today, the one, the only, the magnificent managing partner, Joseph Clark. So glad to have you here, Joe.
Wow. Okay.
Leading you in strong, baby. Leading you in strong.
All right.
Today, we're talking about taxes. I mean, I think we talk about this more often than not, Joe, on the show because it is so important that we get this right, especially when we enter the distribution phase of finance, which is where we're taking resources out of the dollars we've saved, and really want to cover today how much do taxes really affect us and what should we be paying attention to inside of taxes as we get into retirement. One thing that you do really well, Joe, that I think a lot of people resonate with is relating taxes to food, right? I'm a big guy. I love to eat. And so when you talk about broccoli and chocolate cake, it makes sense to me. And unfortunately, we're at a point in time now where a lot of the families that we serve are getting ready to enter retirement. They have these massive tax-deferred accounts alongside them. And they've been told their whole lives, when you retire, you'll make less money. When you retire, you'll make less money. Just defer your money. Don't pay taxes today. Pay it down the road. So why is chocolate cake and broccoli so important when it comes to understanding how taxes are going to affect you during distribution and retirement? And why is that a lie?
Well, there's different age groups, and thank you for all the kind words, Grant, but there's different age groups you got to think about. If you're already 70 or 72 now with the Secure Act and the change in terms of required minimum distributions, the only thing you can look back is say, I hope the chocolate cake tasted good because, excuse me, you did a lot of deferral of income into that defined contribution plan, your 401k, 403b, if you're a teacher, doctor, nurse. You did a lot of deferral, and it felt good, right? Eating chocolate cake with your family feels good. But the reason you go to the gym and it's kind of like eating broccoli, right? You want to have a better long-term future. Well, if you're already over 72 or older, and we have a lot of families who show up now that are 75 and 80 who come in and say, hey, I've done this a long time on my own. I'm ready to turn it over to a professional financial advisor. And that's what we do, right? We take care of families like you that want to make sure that you're not making financial decisions that are incorrect. But regardless, you're over 72, you probably didn't have a lot of opportunities to do a lot of Roth contributions, either in a 401k or in an IRA. And what we will help people do at any age is help people do Roth conversions when those make sense for your world. Let's say you're 65, right? So you're not ready for required minimum distributions yet. You got 7 years to wait. And a lot of people will continue to not take that money out of their IRAs or their 401ks because they don't want to pay taxes. Mm-hmm. I don't want to pay taxes. I get it entirely, right? But the problem is, just like going to the gym, it's going to cause a little bit of sweat. It's going to cause a little bit of soreness. It's going to cause a little bit of pain. You've got to pay the taxes. Either you're going to pay them or your heirs are going to pay them. We need to do this in the smartest way possible to make sure that you stay in the same financial health that you possibly can stay. And if you're younger, do not let somebody sell you on the notion of 100% tax deferral and that your income will be lower in the future and the tax rates will be lower in the future. That is ill-conceived. And all you have to do is look at the demographics, look at the spending that's going on in the federal world, make sure you're putting yourself in the right financial shape.
100%.
So we talk about marginal and effective rates.
Yes.
So what are they? Break those down for me.
Absolutely. And so when it comes to distribution and really getting right what Joe just described, you have to understand that there's two tax codes. First, one for the informed and one for the uninformed. Notice we didn't say for rich and poor. We know what the rules are, and we would be foolish not to engage in those rules to benefit our situations financially. The IRS gave us the playbook. It's just our job now to enact. So when we talk about effective rate and marginal rate, those are very important numbers to understand, and they both definitely matter when you get to distribution. So marginal tax rate, what is that? That is the final part of the stair that you fall on with income when you get to start taking money, or you start taking money out of assets and also earning income over your years. So here's what I mean. So the taxes stair step is like this. 10% is what all of us pay taxes on. Joe, myself, Warren Buffett, right? The next guy down the street. We all pay taxes along these stairs. The first step is 10%. Under the current tax code, the next stair step's 12, and then it goes to 22, and so on and so forth, all the way up to 37. So marginal rate are those stairs. How much are you filling up those stairs with every dollar you earn as you earn more and more and more? That helps us do great tax planning. The effective rate was the average dollar you pay across all of those tax stair steps. And that's very important in distribution when we're talking about tax efficiency, when we're talking about conversions, etc. Because again, that effective rate is what matters, especially when the tax codes change down the road.
Tax codes change?
Oh my gosh. They have changed in a whirlwind, Joe.
All right, so the stair steps you talked about never really have changed. In 1913, the first tax code that under the current system that we use has all had those stair steps, if you will. And a lot of people will say taxes have never been this high. I just want to remind you, when Kennedy took office in the 60s, that the top bracket was 90%. When Reagan took office in 1980, it was 70%. Mm-hmm. A lot of people have some just misguided information when it comes to how the tax code works. You need to understand how those stair steps work. Now, one of the things that Grant would help you with in a Next Steps meeting is building tax diversification so that you can better deal with the marginal and the effective tax rate. So, Grant, what is tax diversification and how do we do it?
Absolutely. So tax diversification is simply building tax-free wealth for yourself, but now and in the future, optimizing using the tax-deferred assets you currently have, and understanding that there are taxable assets out there that can be used for your benefit as well. And how we help families build that is to take a look at their current situation, their current income, where they're at in the tax brackets, and we look at their effective tax rate, and we start essentially moving dollars around to ensure that their tax variability, their tax diversification is appropriate based on the access of things we have today and going into the future. So, for example, if we were talking about a single individual, say we use me as an example, I'm getting ready to retire. I have $1 million of tax-deferred assets, and I have $100,000 of non-retirement assets. Then what we would do is we'd say, what does my standard of living look like? What does my income look like for this last year and this year? And based on that tax bracket, let's say married filing jointly, I'm living in the 12% tax bracket. My standard of living is low. I have very low fixed income. I don't need a lot. Well, we would essentially bracket bump is the term we use. We would take some of those tax-deferred assets, that $1 million, and start transitioning those dollars to a Roth IRA for my wife and myself, because in that tax bracket today it's 12%. And in 2026, I want you guys to understand and hear this, in 2026, the tax code that we understand today will sunset, regardless of what Congress does between now and then. And that means that 12% bracket will revert back to 15%. So we're essentially paying the government a discounted tax rate today so that I can build Roth money, which grows tax-free for the rest of my future. That would be one element or one thing we would do to build tax diversification.
And I think people get that. I think they resonate with the idea of being able to pay less today than more tomorrow. Mm-hmm. But the other thing that I would remind you and to tell you to stay ahead is we don't know what the future tax code is, and we don't know what your future life is, right? So tax diversification gives us the opportunity to be able to pick and choose which dollars we want to spend when. Right? So what Grant is trying to get you to do in the conversation that he just had, and remember, if you missed it, you can always go back and re-listen to it at Consider This Program. Anywhere you listen to podcasts, you can go to considerthisprogram.com and listen to it again if you want to get a refresher on what Grant said. But the idea is that we're going to take your assets that you have today, or the ones that you're saving for tomorrow, and we're going to put them together in such a way that regardless of what the IRS does, we can give you an optimal distribution strategy for retirement when it's time to take out. Grant, I will tell you, and I've said this to you before, and I've said it on the show before, I have never seen anything like the IRS that has separated somebody from their retirement. I've watched people make bad investment decisions. I've watched people not save enough money. And honestly, the IRS is more disruptive. And it's not that the IRS is bad. We need bridges and we need roads. That's not what I mean. But not understanding how the tax code impacts your retirement, not how it impacts the decisions that you need to make. You don't even want to know the horror stories, not that I've read about, that I've witnessed over 34 years of being in this industry.
100%. And the other thing, looking at where we're at here, so NFL playoffs are kind of in the mix, and in tax planning and tax diversification is something that we build year over year, Joe. We've got to have a flexible plan that can adapt to any situation. And I love the phrase you use, we pick and choose the dollars that you can use in any given situation, and that's tax planning. It's not something that we do once and we just keep on track and we don't change it every year. It's something we adapt and modify. Because remember, with tax planning, it's something we have to do before December 31st. And it's something that's evolving, breathing, moving, adapting. But once we get to tax reporting, and that 1040 goes in that drawer after April 15th, the past year's done. And so we have to be flexible and adjust our playbook, our defensive strategy against the IRS every year. So to all of you listening, to the families we serve, just remember, tax planning at the end of the year is so crucial and important, especially if you're going to experience income variability. So when it comes to working with your taxes, understanding how it works, understanding how to bracket bump, do what's necessary for yourself and your family, come in, see our team. See us, one of myself or another advisor on the team will walk you through a lot of the strategies that we deploy for our families with building tax diversification. It's something that has to be done every single year. And remember, a tax packet that we send out to our families comes out in October every single year. So if you have questions about how taxes will affect you in retirement, please give us a call at 800-928-4001 or shoot us an email at yourlifeafterwork.com. We would love to see you. We would love to bring you in, have the conversation on protecting you from the IRS and dealing with a lot of these strategies that we see our families need to deploy over time. Thanks for being with the show. Joe, thanks for being here. We appreciate you.
Hey, buddy. Happy to be here. Again, it's 800-928-4001.